before modern banking existed, before the Medici rose to power, before double-entry bookkeeping revolutionized finance, there was a system that turned religious prohibition into the most sophisticated commercial network the medieval world had ever seen. Islamic finance didn't just work around the ban on interest, it invented entirely new ways to move money, fund trade, and build empires. And in doing so, it created the blueprint for global commerce that still shapes finance today. Welcome to the Money Historian, where money, power, and history collide, and nothing is ever as simple as it looks. In the 7th century, when Islam emerged from the Arabian Peninsula, it brought with it a fundamental economic problem. The Quran explicitly forbids riba, interest on loans. God has permitted trade and forbidden usury, it declares. For most of human history, lending money at interest was how commerce worked. Rome did it, Babylon did it. Every major civilization charged interest because it was the simplest way to compensate lenders for risk in time. But Islam said no, absolutely not. Taking interest was haram, forbidden, sinful, non-negotiable. To Western historians, this looked like an economic death sentence. How could you build a sophisticated economy without interest? How could merchants finance trade caravans across thousands of miles? How could you fund construction, agriculture, or manufacturing without the incentive of interest to attract capital? The assumption was simple. Islamic finance would remain primitive, constrained by religious dogma, while Christian Europe eventually embraced banking and pulled ahead. That assumption was spectacularly wrong. What actually happened was the opposite. Islamic merchants and scholars didn't just find workarounds to the interest ban. They engineered an entirely new financial architecture, one that was, in many ways, more sophisticated, more stable, and more ethical than anything Europe would develop for another 5 centuries. The key insight was this: Islam doesn't ban profit, it bans exploitation. It doesn't oppose commerce, it opposes risk-free returns. The Quran's objection to interest isn't about economics, it's about justice. Interest allows lenders to profit without sharing risk, to extract wealth without contributing labor or accepting loss. That's what's forbidden. So Islamic finance rebuilt itself around a different principle: shared risk, shared reward. Instead of I'll lend you money and you owe me extra, it became I'll invest in your venture and we'll split the profit or loss. Instead of debt, equity. Instead of guaranteed returns, partnership. And from this foundation, Islamic merchants built the most dynamic commercial network in the medieval world. The most important instrument was the mudarabah, a profit-sharing partnership. Here's how it worked. One party provides the capital, the other provides the expertise and labor. Profits are split according to a pre-agreed ratio. Losses are borne by the capital provider, unless the working partner was negligent. This wasn't charity, it was sophisticated risk management. The investor couldn't just sit back and collect interest. They had to evaluate the venture, trust the merchant, and accept real risk. The merchant, meanwhile, had skin in the game, but wasn't crushed by debt if the venture failed through no fault of their own. This structure powered the entire Islamic trading world. Merchants in Baghdad would form mudarabah partnerships to fund caravans to China. Traders in Cairo would finance ships to India. Investors in Cordoba would back textile production in Damascus. The system was flexible, scalable, and crucially, it aligned incentives. Everyone succeeded together or failed together. There were no guaranteed returns, which meant capital flowed to the most promising ventures, not just the safest borrowers. Then there was the hawala system, the medieval world's most elegant solution to long-distance payments. Imagine you're a merchant in Morocco who needs to pay a supplier in Persia. Carrying gold across 3,000 miles is dangerous, expensive, and slow. Islamic finance solved this with pure trust and accounting. You'd go to a hawala broker in Morocco, give them the money, and receive a code or letter. Your supplier in Persia would present that code to their local hawala broker and receive payment, often within days. No physical money moved across borders, just information and trust. This worked because hawala networks were based on reputation, family ties, and community enforcement. Brokers kept their own ledgers and settled accounts periodically through trade flows or commodity transfers. It was faster, safer, and cheaper than moving physical currency. The Silk Road functioned on hawala. The spice trade ran on hawala. Islamic merchants could move capital across 3 continents, while European merchants were still physically transporting coins in armed caravans. But Islamic finance went further. The musharaka was a joint venture structure where all partners contributed capital and shared profits proportionally. The ajara was essentially leasing. You could use an asset and pay for that use without ever paying interest on borrowed money to buy it. The murabaha allowed merchants to buy goods on behalf of a client and sell them at a markup disclosed upfront. Profit from trade, not from lending. Every instrument was designed around the same core principle: money should work, not just extract. And here's what's remarkable. This system didn't just survive, it thrived. By the 10th century, Islamic commerce dominated global trade. Baghdad, Cairo, Cordoba, Damascus. These weren't just political capitals, they were financial centers more sophisticated than anything in Christian Europe. Islamic merchants traded from Spain to Indonesia. They established credit networks that spanned 3 continents. They developed bills of exchange, checks, and commercial contracts that wouldn't appear in Europe for centuries. The checks used in medieval Europe, copied from Islamic sack. The word check literally comes from the Arabic. Letters of credit. Islamic merchants used them routinely while European traders were still bartering. Double-entry bookkeeping, often credited to Italian merchants in the 14th century. Islamic traders were using similar systems 300 years earlier. The foundational instruments of modern finance weren't invented despite Islam's interest ban. They were invented because of it. But the impact went deeper than just financial instruments. Islamic finance changed how people thought about wealth and commerce. In Christian Europe, moneylending was morally suspect, often left to Jewish merchants who faced persecution for doing what the economy required but religion condemned. In the Islamic world, commerce was celebrated. Muhammad himself had been a merchant. The Quran praised honest trade. Wealth wasn't sinful if earned ethically and used responsibly. This created a culture where merchants held high social status, where commercial innovation was encouraged, where financial sophistication was a virtue, not a vice. The Islamic Golden Age wasn't just about science, mathematics, and philosophy. It was funded by this commercial revolution. The translation movements that preserved Greek knowledge, funded by merchant wealth. The architectural marvels from the Alhambra to the Blue Mosque, built with profits from trade. The universities that taught medicine, astronomy, and law, endowed by commercial fortunes. Islamic finance created the economic foundation that made cultural flourishing possible. And then came the collapse. Not of Islamic finance itself, but of the political and commercial networks that supported it. The Mongol invasions devastated the central Islamic world. The Crusades disrupted trade routes. European powers began their maritime expansion, bypassing traditional Islamic trade networks. The Ottoman Empire, while powerful, never fully revived the commercial dynamism of the earlier Islamic world. Islamic finance didn't fail. It was overtaken by geopolitical shifts it couldn't control. Meanwhile, Christian Europe, which had spent centuries condemning usury, quietly started ignoring its own rules. Italian merchants developed creative workarounds that looked like partnerships but functioned like loans. The church looked the other way when powerful families needed credit. By the Renaissance, European banking had essentially adopted interest-based lending while pretending it hadn't. The Protestant Reformation finally made it official. Interest was acceptable. Calvin and Luther both argued that moderate interest was fine, that the biblical prohibitions were misunderstood. Europe's economy, suddenly freed from religious constraints, exploded. But here's the uncomfortable parallel. Islamic finance's principles didn't disappear, they went dormant. And now, in the 21st century, they're roaring back. After the 2008 financial crisis caused largely by excessive leverage, irresponsible lending, and financial instruments that divorced risk from reward, suddenly Islamic finance started looking prescient. The idea that lenders should share risk, that financial instruments should be tied to real assets, that speculation without ownership is dangerous. These weren't primitive restrictions, they were safeguards. Today, Islamic finance is a multi-trillion-dollar industry. Sukuk, Islamic bonds based on asset ownership rather than debt, are issued by governments and corporations worldwide. Major Western banks offer Islamic finance products. Malaysia, the UAE, and Saudi Arabia have built Islamic financial centers that rival conventional ones. The principles that medieval Islamic merchants developed to comply with the Quran's interest ban have become competitive advantages in a global economy wary of another financial collapse. And the broader lesson is even more striking. Constraints breed innovation. Islamic finance couldn't use the obvious tool, interest, so it invented better ones. It built a system based on partnership rather than debt, on shared risk rather than guaranteed returns, on transparency rather than hidden costs. The medieval Islamic world didn't suffer economically from the interest ban. It flourished because of how it responded to that constraint. Prohibition forced creativity. Restriction produced sophistication. This is the pattern that repeats throughout financial history. The most innovative systems emerge not from total freedom, but from intelligent constraints. The Persians built imperial finance under the constraint of managing dozens of incompatible local systems. The British built modern central banking under the constraint of financing constant wars. The Americans built the post-war financial order under the constraint of preventing another depression. Islamic finance built global commerce under the constraint of a religious prohibition on interest. Every time, the constraint wasn't the problem, it was the catalyst. So when you hear about Islamic banking today, don't think of it as some exotic alternative to real finance. Think of it as a 1,000-year-old stress test of whether capitalism can function without exploitation. The medieval Islamic world proved the answer is yes. You can build sophisticated markets, fund long-distance trade, finance, construction, and manufacturing, and create wealth, all without interest, without debt spirals, without guaranteed returns for lenders who take no risk. You just have to be more creative, more disciplined, more honest about who's bearing what risk. Because at the end of the day, Islamic finance's core insight isn't religious, it's economic. Money should be a tool for productive enterprise, not a means of extracting wealth from others' labor. Profit from effort, not from time. Share risk, don't offload it. If you win, everyone wins. If you lose together. That's not just theology. That's the kind of financial wisdom that built empires while Europe was still crawling out of the Dark Ages. If this changed how you see finance, hit subscribe. History has the answers. I'll show you where to look.